Hi bankers, welcome to another episode of IBS Institute of Banking Studies. This episode we are going to discuss the A module of International Banking, and we have been discussing about the various facilities and the various types of accounts which an NRI, non-resident Indian, can open in India. Now we are moving on to the next item, facility of NRI, that is, what are the investment opportunity for a non-resident Indian? See, a non-resident Indian, they can invest in the equities and securities on repatriation or non-repatriation basis. The only condition is they can invest only for those items which are permitted as per the FEMA 1999. FEMA stands for Foreign Exchange Management Act 1999. So there a lot of provisions have been given for the NRIs to invest, and they can invest in both type. Repatriation basis means whatever investment they are making, that amount they can take back in any foreign currency. That is called repatriation basis. Next is the non-repatriation basis. Non-repatriation means the investment which they are making out of the NRI remittance, they have to use it here. They are not permitted to. Normally, they are not permitted to take back. That is non-repatriation basis. And say an individual up to 5% of the paid up capital, they can invest in a company. And NRIs put together, they can invest maximum 10% of the paid up value. And they can invest in mutual fund and the units of UTA. On both basis, repatriation, non-repatriation basis. For company deposit, the minimum period should be 3 years. But remember, these are the items for which the NRI is not permitted to invest. That is on, say, proprietary or partnership engaged in agriculture, plantation, or real estate business. Therefore, if there is a partnership or a firm which is engaged in agriculture or plantation activities, NRI is not supposed to invest. Similarly, for real estate business also, they are not allowed to invest. And the sale proceeds of the immovable property can be taken abroad. The only condition is maximum 2 properties. And here there is a lock-in period. If the person who has acquired this real estate after becoming a non-resident Indian, so a person has gone abroad in the year 2020. After that, he has purchased a property out of the proceeds, NRI proceeds, and if they wanted to sell it, there is no lock-in period. But if a person has acquired a property while he was a resident, and then he got employment or he migrated to a foreign country, and then he wanted to repatriate, then there is a lock-in period. The lock-in period is 10 years. There is one more facility for the non-resident Indians. Not only non-resident Indian, non-resident, foreign nationals, they are allowed to purchase landed property or immovable property in India for all the citizens except these people. That means the person of Pakistan, Bangladesh, Sri Lanka, Afghanistan, China, Iran, Nepal, Bhutan, Macau, and Hong Kong can acquire. So foreign nationals of Indian origin, except. So these exceptions are there. So what I have listed some countries, those people are not allowed to acquire landed property in India. Others, they can they can acquire the property without RBI intervention. So next is, what are the different types of loans? NRIs are permitted to avail a loan against their deposit, subject to the margin requirement. The depositor themselves can avail the loan, or to third party. There is no limit, only the margin. And the margin is 10% as of now. And no loan, similar to the previous one, I told you about investment. So these loans, suppose a person is having a deposit and he wanted to take a loan, or his relative or a third party against the deposit, and the customer is coming, please grant a loan to so and so. That is, you can give against the security of the property. But the purpose of this loan should not be for these activities, agriculture, plantation activities, and real estate business, or lending, re-lending. For these purposes, banks are not allowed to grant a loan to the NRI. Then proceeds cannot be repatriated. So suppose a person is having an NRI deposit or FCNA deposit or NRO deposit against which they have taken a loan, This loan amount cannot be repatriated. Means this loan amount cannot be transferred to a foreign country. They have to utilize it within India. Next is the overseas branches and foreign correspondent. They are also permitted to grant the loan against the deposit held in India by these non-resident Indians. For example, there is a person A. He is maintaining a deposit account in India, say NRI FD for say 1 crore, and he wanted to take a loan. He is from say Dubai, so he can avail a loan in Dubai, either in the branch of an Indian bank. This particular bank may have a branch, so that overseas branch they can avail a loan. Say, let us assume State Bank of India has got a branch in Dubai. So this State Bank of India, the Mumbai branch, the customer is maintaining an account with State Bank of India Mumbai, and they have a branch in Dubai. So the customer can approach Dubai branch of State Bank of India, and they can avail a loan against the deposit held in India. Clear? Second thing, suppose State Bank of India doesn't have a branch in Dubai, and there is a correspondent of State Bank of India, say BBME, British Bank of the Middle East. So this customer can approach the correspondent bank, and against the deposit held in India, they can avail a loan, subject to marking and other things. And here, in the case of fund held in NRI and FCNR only, that means if a person is availing a loan at the overseas branch or at the correspondent bank abroad, then the loan can be granted against NRI and FCNR deposit. No loan against NRO. But if the person is availing a loan in India, you can grant against NRO also. NRO deposit also you can grant a loan. And here, next is the housing loan you can grant. There is no restriction as per the usual terms and conditions we can grant. Proceeds should be credited to the NRO, not to the NRI account. And the loan should be secured by EMI, equitable mortgage. And the repayment should be from NRI account or NRO account or FCNR account or from the rental proceeds of the house or flat. We'll move on to another important concept, that is capital account and current account. See, first I will define about what's a capital account, and then it will be very easy which are the current account and which are the capital account. So very simple concept. I will be giving you the definition for what is meant by a capital account, and if a particular transaction is not capital account, it is a current account transaction. So broadly, the Forex transaction you can divide into two categories. One is capital account transaction, another is current account transaction. Let us assume there is a person. This person is a resident. This person is a resident in India. This person has made an investment in USA for US dollar $250,000. Some sort of investment. So look, this is a resident person. He is a resident Indian. He is residing in India. He has set up a business activity, or he has made some investment, some security, some international security. He has invested abroad. This is a capital account transaction. Because here, this person is residing in India. He has made a transaction out of which there is a change in his asset abroad. So what happened? His asset is increased abroad. So remember, when you say a transaction, a Forex transaction is a capital account transaction, as far as the resident is concerned, for a resident person, if he has made a transaction by which there is a change in his asset abroad, that's a capital account transaction. Second situation, suppose he had taken a loan from UK for GBP 10 lakh. So this person had taken a loan from where? from UK, outside India. This is also a capital account transaction because there is a change in his liability. Here there is a change in his asset. Here there is a change in his liability. Therefore, remember, what is a capital account transaction as far as the resident is concerned? When a resident Indian make a transaction, and by which, if there is a change in the asset or change in the liability or a change in the contingent liability, is a capital account transaction. So change in asset or change in liability or change in contingent liability where abroad. So look, I'll put another thing. This resident Indian, he has taken a loan of say 1 crore Indian rupee in India. He has taken a loan within India, not outside. This is not a capital account because it's a resident transaction, it's a domestic transaction. This is not a Forex transaction. So this will not come under capital. Or suppose he has made an investment of 1 crore. This is a loan. This is an investment. He had made an investment in India for 1 crore. That's also not a capital account because there is no change in the asset or liability abroad. So remember, as far as the resident is concerned, the change in asset or liability or contingent liability should happen abroad. Second category is a non-resident. As far as the non-resident is concerned, if there is a change in his asset or there is a change plus or minus, as addition or subtraction, plus or minus, change in liability, where in India. Therefore, as far as a non-resident is concerned, he is putting through a transaction, and when he completes this transaction, there is a change in his asset in India, or there is a change in his liability in India, or there is a change in the contingent liability in India of this person. I'll give an example. Say a non-resident means it is not only the NRI, it can be a foreigner also. It can be a foreigner also. Say an American. Let us assume an NRI has made an investment in India. It's a capital account transaction. Or an NRI residing abroad, he has taken a loan from India. It's a capital account because there is a change in his asset or liability. Or he has repaid some loan. Again, there is a change. It's a capital account. Now, second category, let us assume there is an American. He's a non-resident. He's a foreign national. He's an American. He has invested some money in India. Again, that's a capital account. Or this foreigner had taken a loan from India. Again, that's a capital account transaction. So this is the definition for capital account transaction. And if a transaction is not a capital account, it is a current account transaction. So look, this person, this American or this NRI, he is in Dubai, he had taken a loan in Dubai. This person is an NRI, he had taken loan in Dubai. Is it a capital account transaction? No. Because nothing to do with India. So there should be some relation with India. He is a non-resident Indian. He is residing in Dubai or he is residing in US. From there, he has taken a loan from Germany or Japan or Dubai. So we are not connected. So as far as that transaction is concerned, it is neither a capital nor a current account as far as we are concerned. So we are concerned only if the change in asset or liability takes place in India, if he is residing outside. And if a person is residing in India, there should be a change in asset or liability or contingent liability abroad. Then only it's a current account transaction. So let us move on to the definition. This is the definition for a capital account. A transaction which changes the assets or liabilities, including contingent liability. What is contingent liability? It's a liability. As of now, there is no liability. But on a later date, it can change to a liability. So that's called a contingent liability. So contingent liability outside India of a person residing in India. Second example, individual remit foreign exchange abroad to invest in the shares of an overseas company, thereby altering the asset. Second, a transaction which changes the assets, liabilities, including contingent liabilities in India of a person resident outside India. Example, an American residing outside India investing in the landed property in India. So this is the definition and example of a capital account transaction. Current account, there is no confusion. A Forex transaction, which is, if the transaction is not a capital account transaction, we call it a current account transaction. So what are the examples? All trade-related transaction. International trade, domestic trade will not come in that. Trade, when I use the word trade, you can divide into two, domestic trade and international trade. Domestic trade means both buyer and seller are residing in India. That is not an international trade. International trade means export or import. Export means goods goes out, we receive foreign exchange. Import means goods comes in from a foreign country and Forex will go out. So this export trade and import trade are coming under current account transaction. Then all miscellaneous remittance are coming under current account transaction. What is miscellaneous remittance? Remittance towards travel, education, medical treatment. All this falls under miscellaneous remittance. Then the loan, if suppose a loan has been taken abroad, the interest on that loan, interest paid on that loan, or there's an investment abroad, the income or the return or the interest received on that investment, that is also considered as current account. So here you see, it's a transaction. If a transaction is a Forex transaction, is not capital, it's current account. It includes the payment related to foreign trade, both export trade and import trade, interest on loans. If an entity has taken a loan outside India and towards the interest for that loan, that is a current account. Then income on investment. If somebody has invested abroad, the income on that, that's also current account. Then expenses connected with education, medical or family maintenance. These are all the miscellaneous remittances. So look, an NRI, he is working in Dubai. If he has sent 1 lakh rupees for meeting the tuition fee of his son in India, so that 1 lakh will come to his SB account, it will be taken away. It is not an investment. There is no change in his assets. It's a current account transaction. Another remittance he has made, it is 1 lakh. This 1 lakh is please put in a fixed FD for 1 year. That's an investment. So that 1 lakh is a capital account transaction because there is a change in his asset. Whereas the other one, the tuition fee, it will come to the account, that will be immediately they issue a check in favor of the education institution. So that is a current account transaction. So next we'll move on to LRS. Every time they used to ask a question on this LRS. LRS stands for Liberalised Remittance Scheme. You must be knowing the LPG regime in India started off in early 90s. So what is LPG? LPG stands for liberalization, privatization and globalization. When our Manmohan Singh, when he was the finance minister after retirement from Reserve Bank of India governor, he has started off this LPG, this economic reforms in India. As a part of this economic reforms, this liberalized remittance scheme has been introduced way back in 2004. So under this scheme, the remittance, there was some liberalization in outward remittance. See, a resident Indian, prior to that, there were a lot of restrictions for making remittance outside India because we were having a lot of scarcity in Forex reserve. But now we have improved our reserve position, our balance of payment position. So the rulers felt we can relax it, and therefore the scheme has been introduced in 2004. So when the scheme was introduced in 2004, the limit was $25,000. So the maximum a resident individual, he can repatriate or he can avail foreign exchange up to $25,000 or its equivalent in any other permitted foreign currency to a foreign country for both current account transaction and capital account transaction. So that was the scheme was introduced in 2004. Then the scheme was going on. A lot of people made the remittances abroad, either for investment or for miscellaneous activity, education, travel, treatment and other things. And then the government felt we can raise this limit. So they increased the limit to 1 lakh, to 125, again back to 75. And as of now, the limit under LRS is $250,000. This limit, please keep in mind. So for certain, I will be explaining, for certain types of activities, either for current account or capital account transactions, 250,000 per individual can take from India in the form of any permitted foreign currency abroad for the specific purposes. And let us assume these are all the eligibility and other conditions. Who are all eligible for this LRS remittance? A resident is eligible. A resident, an NRI is not eligible. Therefore, a resident Indian is eligible to take maximum of $250,000 or its equivalent. So I'll be mentioning dollar. So it doesn't mean that you can take only, you can allow only in dollars. You can allow remittance of foreign currency in any permitted currency. Dollar, GBP, Japanese yen, Australian dollar, Canadian dollar, Singapore dollar. So any currency, permitted currencies. So here only the resident individual can avail this facility. But the resident individual, I say, even the minors are eligible. So a family comprises of, say, 4 people, husband and wife, 2 children. And the one children is of 3 years, another child is of, say, 1 month, 2 months or 3 months. That child is also eligible for this remittance, 250,000. So including minor, they are eligible. But here, suppose a person is having a business activity. And this business activity, it is under a proprietorship, sole proprietor. So in that case, either he can take this 250,000 in a financial year in the name of that firm or in his individual name. He cannot take in both. For example, A is running a business, it's a proprietary business, and in the name of that firm, he can take 250, then individually he cannot. If he is taking in his name, then he cannot. So either in one name, he can take this 250,000 per financial year. So that please keep in mind. Then who are not eligible? A non-resident Indian is not eligible. A HUF, Hindu Undivided Family, is not eligible. A partnership firm, a corporate or a trust is not eligible. Means all companies, all partnership, they are not eligible. Proprietary, they are eligible, sole proprietor. But partnership, they are not eligible. And what is the period? Financial year. Per financial year, every financial year. Financial year means 1st April to next 31st March. Next, what are the documents? Very simple document. Amount is 250,000 or its equivalent. Documentation is very simple. A PAN and a Form A2. Form A2 is an application for making remittance. So, miscellaneous activity. Therefore, these 2 things are required. Purpose for any permissible activity, current account and capital account. Number of occasions, there is no restriction. That means a person comes in the month of April. He comes, give me $10,000. You can give. The purpose of the things I will explain. And after some time in June, he comes for another 30,000, you can grant. Then in September, he again comes, you can grant. In December, in January, February. So any number of occasions you can allow in a financial year. But the only condition is the aggregate amount in a financial year should not exceed $250,000. Now, this I am not explaining much. You can just go through it. There are 3 schedules. As per this liberalized remittance, RBI has classified the purpose into 3 schedules. So Schedule 1 is negative list. That means for these activities, see, it is not allowed. It is not allowed. The remittance you cannot. The bank has not given any power for making a remittance for these purposes. So remember, the purposes listed under Schedule 1. It is the negative list. That means a resident Indian is not allowed to request for making a remittance for any of these activities. Now, next is Schedule 2. This Schedule 2, they have listed again certain items. And in this item, you can go through the items. you can allow only after getting the permission from the government or Reserve Bank of India. So Schedule 2, after approval from government. These are all the items. So if anybody wanted foreign exchange for these activities, they have to apply to Government of India, detailing the purpose, and on merit, RBI may allow. So then only as an authorized person, you can release the Forex for these activities. Now coming to Schedule 3. This is, as far as a banker is concerned, you are supposed to know. So under Schedule 3, there are certain purposes for which you are allowed to make the remittances without reference to Reserve Bank of India. That means the power has been delegated to the bank, to the authorized persons. Number one, visit to a foreign country. A person is going for a tour for visiting a foreign country. But here restriction other than Nepal and Bhutan. That means if a person is visiting Nepal or a person is visiting Bhutan, even though these two countries are not part of India, it's a foreign country. But we don't release foreign exchange for visit to these two countries. The reason is, in Nepal and Bhutan, Indian rupee is permitted. So you can do the transaction with Indian rupee, and that is why if a person is going to Nepal or Bhutan, you cannot release foreign exchange. Next is gift or donation. You can allow gift or donation. Then for employment or immigration or maintenance of close relatives or travel for business by resident individual for attending the conference or training. Then the attendant to a patient for treatment, you can allow expenses in connected with medical treatment, studies abroad, and purchase of objects of art subject to FTP, and others, remittance towards health insurance, etc. So these are the various purposes for which you can release the foreign exchange subject to the ceiling without a reference to Reserve Bank of India. Now again, we will come back at the operational instructions. PAN is mandatory. Therefore, if a person is coming to you, give me some foreign exchange. PAN is mandatory. Without holding a PAN, this person is not supposed to avail foreign exchange from the bank under LRS. So PAN is mandatory. Remittances, both capital account and current account, you can give if the purpose is listed under Schedule 3. And no restriction, already explained. The amount should be 250. And this also explained. Credit card, international debit card, and ATM card can be used for current account transaction. And foreign citizen, resident in India, other than Pakistan citizen. And we have seen in one of my sessions, there is a category, they are called RNPR, resident but not permanent resident. Under this category, who are all coming? The foreign nationals. A foreign national, if he has come to India either for employment or for some other activity, then he can open a resident account. And that resident account, he can continue. If it's for employment, there is no restriction. If it's for some other purpose, the restriction is maximum 3 years. So up to that period, he can have this account, and this person can avail foreign exchange under LRS. So a person is a foreign national, he has come to India, he is working in India, so he gets the salary. Out of the salary proceeds, he can repatriate maximum $250,000 in a financial year abroad. A new customer, you have to carry out the KYC norms, due diligence on the opening of the account, and you should call for the income tax assessment order and the funds in and funds out in the account. All these details you should ensure. And documentation, then Form A2, that's application, the request as per FEMA, then declaration of sources, from where you got the source. That is very important. And irrespective of the PAN is there, irrespective of the amount. Then in the case of travel, confirmed ticket and visa is required. Then this point is very important. TCS has to be collected. Tax should be collected at source. This has been introduced in 2020 as by a finance bill, and therefore it is the responsibility of the bank while releasing foreign exchange to a resident or to the under RNPR. It is the responsibility of the bank to collect the tax at source. That is called TCS. You are familiar with TDS. TDS stands for tax deducted at source. That means whenever a bank is making a payment towards pension or salary or some other services, it is the responsibility of you or the banker to deduct at source. That is TDS. Now TCS is tax collected at source. When a customer is giving you some money for some certain purposes, that means for LRS, it is your responsibility to collect the tax. That is TCS. And there is a detailed guideline I will be explaining. And for up to 25,000, the documentation is very simple. This also they have asked. For simple, under LRS, for simplified documentation, the cutoff is 250,000. Sorry, 25,000 US dollar. So remember, if a person is making a remittance up to $25,000 under LRS, then the detailed documentation is not required. Just a PAN and an application is required. Then in the case of a tour operator, so a tour operator, if he is conducted tours, then he will be collecting the money from the persons. So in that case, he can open a special foreign currency account with a bank in India for making the payment towards the transaction for the tour.